Welcome to Maritime Mind. Today I'm talking about Bootstrap versus VC, and we're going to talk about the pros and cons of both options and why Bootstrap was the right path for me. So when you set out to build a software product, there is a fork in the road that we just all approach. You can't avoid it. We have a choice we got to make, Bootstrapped or VC. Now, the answer to this question depends on who you are and what your goals are. Most importantly, it also depends on the problem you're trying to solve. There is also a newer third option that is growing in popularity, and I'll discuss that later in this podcast. This could be a great option for bootstrappers that want to build long-term sustainable companies, but they need a little bit of funding to get there. Now, for me, I obviously went the bootstrap path, as I said, but let me explain my reasoning for this and why it's the right path for me. I want to first say, though, that I'm thankful the VC route exists. I realize that some big pie-in-the-sky business ideas would not be possible without it. If you look at companies like Airbnb, Uber, Spotify, they all took massive capital to build and scale. That's because these products involve network effects, and they also needed to jump through legal hoops just to even exist. So network effects require a supply and a demand side. It's a classic chicken and egg dilemma. They need both from day one, too. So imagine a marketplace without any sellers, or vice versa, a marketplace with no customers. What good would that be? All right. So another thing is these products were all very disruptive to established industries, and that can cause a lot of problems, and extensive legal costs come with that. You could look at Uber with taxi drivers as one example, or you could look at Spotify streaming versus the traditional distribution model for MP3s. So these types of businesses would have been impossible to build like we know them today without outside capital. If your software product will take extensive resources to scale, then VC is the right path for you. Let's talk about how I got here. My purpose for building is freedom. You can't have freedom if you're captive to your company, though, as you would be with a VC rocket ship. I work to live. I don't live to work. I value autonomy and flexibility in my career. I'm striving to build startups with small teams and build products that can be automated. This leaves room for a life outside of work. I don't want to have to choose between my career and my family. That is not a decision I am willing to make. You will not catch me sleeping under my desk like maybe, say, Elon would. All right. Today, many software products do not require extensive resources to build and scale. Technology is continuously getting cheaper and more accessible. The funding companies get from VC also comes with strings attached. Let's talk about those strings, all right? So when you go the VC route, you're giving up control in exchange for funding. Your VC now owns a share of your baby, and they often also have a board seat and voting rights to go with it. It's not just your company anymore, it's theirs too. So be aware of that. Be aware of what you're giving up there. So VCs want a return on investment. Sometimes this incentive doesn't align with the founder's vision for their company. It's common for investors to pressure founders into making their companies publicly traded. This is a great way for VCs to maximize their return on investment, but if you're building for the long term and you have a vision for your company, it will likely conflict with that of your investors. They want a quick return on investment. So I decided a long time ago that I don't want to be involved with publicly traded companies. The incentives for publicly traded companies just don't align with my values. When a company becomes publicly traded, it loses the ability to plan for the long term. The focus shifts to quarterly reports then. This can make publicly traded companies less resilient over time. Also, publicly traded companies have a shareholder obligation to maximize profits, and sometimes this obligation comes with compromising on ethics and ecological costs as well. I don't want to build a soulless business that grows just for growth's sake. I'm fine building a business that starts small and grows sustainably over time. Now, I have a quote here from a hero of mine, D. Hawk, and if anybody knows about publicly traded companies, it's him. He founded Visa after all. So it goes like this: expecting those who control massive, monetized corporations to work for long-term societal prosperity rather than short-term profit is like expecting a dung beetle to leave a pile of manure, climb a flower, and sip nectar. It's the nature of the beast. So what he's saying is that publicly traded companies exist to make a profit. That is their incentive. And often this comes at society's expense, unfortunately. So I want to build privately held businesses that are able to make long-term decisions. And I want these long-term decisions to be for the best of society. Now, we have a lot of models we can learn from with bootstrappers that have been massively successful. I know it's possible to build sustainable, privately held businesses because there are plenty of models to follow. Let's look at some of them. So 37 Signals, founded by Jason Fried, Carl Segura, and Ernest Kim, has been around since 1999, and they've been building software without VC money ever since. They did agree to an investment from Jeff Bezos at one point, but let me tell you about this. This investment came after they already had leverage from years of profitability. And also, this investment came under the agreement that they'd never go public and they'd retain control of their company, most importantly. So don't expect these same terms for your MVP software product with no customers. The reason they wanted this investment was they just wanted to diversify their money a little bit because they had basically everything in 37 Signals and they just want to take some money off the table and diversify. But don't expect that unless you have leverage, all right? So we can also look at who's been killing it in the build and public community for a while now. We have names like Danny Postman, Arvid Kao, Peter Levels, then now recently Mark Louis-Villain. These guys started as solopreneurs, and now some of them have VAs, editors, designers, and even ML engineers working for them. This lets them ship more and ship faster. This also allows them to solve more complex problems than a typical solopreneur is capable of. They've also, in this time, they've also developed massive audiences, which helps a lot with their distribution. And it's great to learn from their success for sure. You can definitely apply a lot of lessons from what they do to yourself. So as I said earlier, there would be a third option that I discuss. And this option just recently came to my attention when, speaking of Arvid Kao, he took funding for his startup Podscan. But guess what? This funding did not come from VC. This funding came from the Calm Company Fund. Now let's talk about Calm Company. So the Calm Company operates under a different model than VC. When they invest in a company, the focus is on sustainable growth, completely different than the unicorn or bust model that VC follows. So the structure of their shared earnings agreement, SEAL, makes sure that their incentives are aligned with that of the founders. Okay, so let's break down the SEAL right here. So investors get a percentage of the founder's earnings once they reach a certain threshold. These shared earnings are capped, though, importantly. So another thing is, and this is really important, they get no equity, they get no shares, they get no board seat, and no preferred voting rights. So founders keep control of their companies. That's important. And the last but not least is it includes a ratio of equity basis over valuation cap. And this defines a percentage of the company that investors are entitled to in two scenarios: if the company is sold or if more capital is raised. So the equity basis is reduced over time as shared earnings payments are made, but there is a residual equity basis that remains after the shared earnings cap is fully repaid. And this way, investors are still incentivized to help founders keep building the company. All right. So this is a completely different approach than your typical VC. It allows founders to secure funding for their SaaS without giving up control. And it's kind of it's like a bit of a hybrid approach between the typical bootstrap path and the VC route. I think it combines the best of both worlds. It's like you get to have your cake and you can eat it too. How great is that? At least from my perspective. So they have an impressive track record with the companies they've founded so far. And that's important, right? They've funded around 70 companies and most of them are still around today. But if you compare that to a typical VC, it's like hit or miss with everything they invest. It's very high risk, where the reason for their success, though, is they are very selective about the companies that they fund. Don't expect to bring them some MVP with no customers and get funding. That's not going to happen. You need to have established distribution channels, and you need to have a lot of paying customers as well. They also want to invest in founders that have an unfair advantage, like they could have an audience, or say they maybe have some unfair advantage in the market, like maybe they worked at fintech and they leave fintech and create a fintech app, something like that. Something they have an inside advantage from their network or whatever. But you need to have some type of leverage to even be a viable investment opportunity for them because they're selective. They have to be. And I'm excited to see if this approach continues to grow in popularity. It's a path I would consider for myself, though, with like the right business once I had that. Now, let's talk about technology. None of this would be possible without the progression of technology. So, technology keeps expanding the possibilities with bootstrapping. One example that everyone obviously knows about is LLMs. So, since LLMs came on the scene, the rate of development for me has probably at least 4x. So, I used to get stuck on problems for weeks at a time because my only resources were Stack Overflow, Google, and the docs. And I can tell you, I do not miss those days one bit. Now, I have GPT-4 as my coding assistant, handling tasks that used to be very time consuming for me. One of the advantages of LLMs is the speed at which they can aggregate information for you, much quicker than a typical Google search would be, right? LLMs aren't great for writing code yet, though, at least not yet. So don't expect to give them a prompt and say, hey, build this app for me and expect to get one back. You're not going to. They're limited by their ability to understand extensive context, and they're also prone to hallucinations. Another thing they're limited by is their cutoff date of their training data. Today, if you tried to ask GPT-4 about Next.js app router or metadata API, it will not know what the hell you're talking about. Its training data was cut off in 2023 before this tech was even existed. So it wouldn't be much help there. It might even make up an answer and hallucinate. So be aware of that. So a big part of the process of using LLMs is knowing when to call them out on their BS. Like you just can't blindly trust their output. They should only improve from here, though. They're a moving target. You do not judge technology from where it is. You judge where it's going. And in 5 years from now, you might be able to say, hey, ChatGPT, Gemini, whatever, Claude, whatever it's called, say, hey, build me this. And it literally goes and builds it for you. Like, actually, not just like bits and pieces of code. All right. So outside of AI, we also have some other exciting technology that's been progressing: quantum computers, bioengineering, nanotechnology, and all this will produce very disruptive technologies. When we combine all this tech with AI, things start to get really interesting. It's an exciting time to be alive, to say the least. Now, I believe the rate of evolution for tech will continue to accelerate. This will only unlock more opportunities for founders that are ready to seize them. You know how they say opportunity finds the prepared mind? Well, that's going to be the case here as well. So with the tech accessible today, the need for larger companies is dwindling. Now, Naval had an interesting take on this. He said the actual efficient size of a company is shrinking very rapidly. So the future will be almost all startups. Now, he said that in an interview back in March, like a month and a half ago. And if you should go and watch the full interview, it's really interesting. But we no longer need extensive resources to innovate and solve problems. This makes it practical for solopreneurs or small teams to build products that have a massive impact. I think the next Google or Facebook will likely be built and sustained by a small team. I'm talking teams of maybe around 10 people rather than the tens of thousands at Facebook and the well over 100,000 plus at Google. Now, most recently when I looked at Facebook's employees, I think it was at like 90,000, and then Google was like 180,000. That's crazy. I mean, at that point, they can't even tell who are the A players for them and who are the C players. They can't separate the good from bad because they have so many. I think we will see less of a need of VC investment in software companies, at least, as technology continues to evolve. And this will empower individuals and give them an edge over large, less agile corporations. Think small companies with a big upside, right? So that's why I chose the bootstrap path. But there is more than one way to cook an egg, ladies and gentlemen. You could have it sunny side up, or you could have it scrambled. There's also multiple approaches to launching a software product. Each approach has its trade-offs, so pick the path that is right for you and the problem you're trying to solve. That's all I have for today. Thank you for tuning in. If you do me a favor and leave a review down below, that helps push the pod to more people. I really appreciate the support. All right, thank you. Take care.